What's up, guys? So the year started off like this, and now in May, it's looking like this. I'm usually making videos on option education or what stocks are a buy, but let's be honest, right now it's more important to know what not to buy. Almost all the talk in my group is about making weekly income, but once in a while, it's okay to sit back and not touch the market for a week considering the VIX is again around 30. Avoiding losers can save you a lot of money, and with this unpredictable market, it's best to preserve your capital so you can start making money again when the market stabilizes. A lot of investors are calling the bottom. Jim Cramer said the storm is passing, but I don't know if I can trust them or Cathie Wood or really anyone. On the other hand, Dan Ives is a very respectable analyst and he was on CNBC and his quick take was very interesting. But I'll tell you what's wrong with his opinion.
Let's welcome the Wedbush analyst to Post 9 to make his case. You really think this is a generational buying opportunity?
Well, I think for the right stocks, but because our viewpoint covering tech since late 99, in these downturns, you got to separate the froth from what we believe are the names that are going to be able to navigate and valuations that we believe are way oversold. So I look at software, cybersecurity, I look at names like Microsoft, you look at names like Amazon, Apple, among others.
Apple and Amazon? This guy's talking about the big tech stocks. Although I like them, I don't think there are generational buys right now. I'd stay away from Apple, which is where I'll get started with the first stock. Apple reported quarterly earnings in late April, and the results continue to demonstrate that Apple is focusing on the correct segments for growth and profitability. Overall revenue grew 9% year over year to $97.3 billion, and they generated a whopping $28 billion worth of operating cash flow. Specifically, Mac segment and service segment were leading. Though this is bullish news, Apple has to keep innovating to keep shareholders happy. If they miss on revenue or profitability, investors quickly sell the stock. Ongoing volatility caused by supply chain disruption, inflation, war, and Federal Reserve changing policies dragged the whole tech sector down severely. The Nasdaq is down from like 16,000 in November 2021 to below $12,000 today. Apple is only down 20%, whereas Amazon is down 34%, Netflix down 67%, and Facebook down 40%. So Apple was not dragged down as much as the other tech stocks. And if we see a recovery, I don't think Apple will recover as much as the other technology stocks will. That's why I think right now Apple is on my avoid list. It's dead money that's unlikely to give investors significant revenue in the short term. Again, I can't be bullish on every stock. I know there's a lot of retail investors holding Apple, and there is even channels out there built around the stock, but I have to give you my objective opinion when I make these videos. And if you appreciate the truth without any of the hype, liking this video would be much appreciated. Next stock I'm going to avoid is Docs and Teledoc, specifically Teledoc. Cathie Wood bought it before the reported earnings, and subsequently the stock fell 50% after. Year to date, TDoc is down 64%. When the US raced to lock down the country in the face of a quickly spreading novel disease, telehealth made perfect sense. While telehealth remains an important tool for doctors, it no longer seems likely that the vast majority of healthcare is going to be online. And going into 2023, it looks like the more exciting developments will be on the ground healthcare. In February 2021, Teledoc, a major healthcare platform with a focus on chronic care, amazing niche, stock hit basically $293, almost $300 per share. It has since gone completely backwards down to $34 per share, losing about 80% of its value from its peak. But I still think this stock is not cheap. Take a look at the short interest. I like short squeezes, but we are past GameStop and AMC activism. This almost 20% total share figure reflects that the stock is likely still overpriced. Their debt is $1.5 billion, while their cash is $800 million. The bigger macro trend here is that telehealth is starting to see some declines from its peak during the pandemic, where we didn't have much choice other than see our providers virtually. Teledoc should be trading for a discount, but it's still trading for more than 30 times free cash flow, with lots of debt on its balance sheet. If you're a long-term investor, maybe Teledoc could be okay, but in 2022, I would avoid this stock. Next stock that I would avoid is Twitter. I would be very careful with Twitter, and in fact, I made sure to discourage my Discord members from buying the stock because I look out for their consistency. And I did not think that Twitter could be consistent, and the reason is because you're working with Elon Musk. This man is a genius, he's amazing. I love Tesla stock, but there is nothing consistent about this man. Some people said that this play would be easy money because of something called merger arbitrage. Merger arbitrage goes like this. Let's say that the stock is $50, okay? But the deal is supposed to go through for $52, and we don't know when that deal is going to happen. happen. However, that deal is likely to happen. So if you buy the stock for $50, eventually you will get paid $52 when the deal closes. So there's a $2 amount that you can make. However, this all relies on the deal following through. Now, I think a lot of deals do follow through, except for some of the big ones that are like antitrust, and the government doesn't want them to go through because they would be a monopoly. And those do happen, and a lot of the deals do go through. So I could see why some people would think that would be easy money. However, with Twitter, absolutely not. I did not think there's a high probability for this deal to go through. And if it did go through, I thought that it would probably take like at least 6 months. And given that it would take 6 months, I didn't think it was a good deal, even if it did go through, because there's so much more money that you can make by just trading options and selling them rather than waiting for a stock to go up by $2. So that's merger arbitrage. And I thought that the risk was way more than the reward for Twitter, and I ended up being right. But I knew that the risk would outweigh the reward. Now, there was a comment and it said, temporarily on hold pending details supporting calculation that spam and fake accounts do indeed represent less than 5%. This comment came from Elon Musk. He wants to make sure that there is not that many spam accounts on Twitter. Musk said that the fake accounts are a key target that he's hoping to eliminate if he completes his purchase of Twitter. Now, he wants to make sure it's not an absurd amount, say like 15% or 17%. So now he wants to do his due diligence, but in my opinion, he has an ulterior motive for doing this due diligence. The reason for this is probably two different reasons, okay? First of all, now that the market is going down, Twitter as a tech stock should not be trading at $45 or $48 when he first proposed the deal. In fact, Twitter should be trading a lot lower, just like the rest of the tech stocks. So in theory, Elon Musk probably wants to get a better deal. But my second theory is that he will take a lot of time away from Tesla, and he might have not even known that himself. But after this deal was announced, Tesla stock fell a lot. I mean, a lot. And the reason for that is because your attention is going to be split between more companies when you're involved with two companies. And investors and shareholders don't want Elon Musk to think outside of Tesla. They want him to focus on Tesla. And because that's going to be a significant time sink from him, the investing community has sold off Tesla, shareholders have given him doubt, and I think he himself has realized that maybe it's just time to think about Tesla and SpaceX and scale those businesses further rather than purchasing Twitter. So anyways, Twitter has fallen a lot, and I think it's going to hover around these levels, and I would pretty much stay away from it because I don't think it's going to go up anytime soon. Last and fourth stock is PTON, Peloton. Now, folks who were used to exercising at gyms and other away from home facilities were forced to make other arrangements. They had to buy, equipment and Pelotons for their house so they can exercise at home during the pandemic. Peloton's in-home interactive exercising equipment was basically an obvious choice. That's why they made so much money. And a lot of people were thinking this stock was going to go to the moon. However, I was just never a bull on Peloton. I think it's so important to avoid those bad stocks because a lot of people are recommending some stocks. And even if one of those falls by like 80%, think about what that does to your portfolio. Even if you have maybe a 10% position in a bad stock and it falls 80%, you're down 8%. That's no joke. It takes a lot of work to get back that 8%. So the boom in Peloton was really short-lived, and consumers quickly returned to their previous habits when economies started reopening. And I think a lot of people don't want to be stuck home all day. In fact, mental health, come on, there's a big issue right now with mental health in the US, Canada, I'm sure all over the world. Staying inside is just against human nature. We're meant to go out and experience life and be in contact with people and talk to people. I think it's so weird to stay home all the time. And I think a lot of people are finally, going out to the gym again, mask requirements are going down. So a lot of people are going to outside facilities again. They're going to gyms. Gyms are starting to do well again. And that's a really bad thing for Peloton. But again, I was never a bull on Peloton, and I think this is a stock to avoid because customer demand is slowly, but honestly, sharply falling for Peloton's products. I don't think people really need a Peloton if, again, they can go outside, get some fresh air, go on a bike ride, or go to the gym. There's so many other options out there than having a Peloton at home, and plus so many people already bought Pelotons and they're reselling them online. So I think it is completely saturated for, if you want to follow along with my portfolio, get all my trades, make profits with me and the rest of the community, then make sure to check out that link in the description. It's going to be a free training. After you watch that free training, you can book a free call with an option enrollment specialist and just talk about my program and see if it's a fit. If it's not, no worries, but it has been a tremendous benefit to so many members. We've been consistent with profits, especially during this bear market. We have outperformed the general market. So I'd love you to hit that description link, and I'll see you in the next video.